Well, this is still the most hated V-shaped rally. And it, of course, has a lot to do with when stocks fell in a waterfall decline into April. Nobody likes to be sitting on stocks. So a lot of folks liquidated at the lows. But we know that whenever the VIX is above 60 and falls below 30, you've made a decisive blow. And now visibility is better. Tariffs aren't as bad as we expected. And the inflation impact actually has been very muted. And actually, outside of tariffs, underlying inflation is actually much lower than people expected. And I think the Fed is, even if they're holding now, the bond market doesn't believe it. If you look at the 2-year, they think the Fed's 2 cuts behind. The 10-year is now down to 4.2, which means the Fed can be more dovish in the next 12 months, and that's a tailwind for stock.
Tom Lee opens by addressing a psychological reality most investors are grappling with deep distrust. In the current rally, after the waterfall sell-off into April and a VIX spike above 60, many panicked and sold at the bottom. But once volatility cooled and the VIX dropped below 30, it signaled a decisive turning point, according to Lee. These sharp V-shaped recoveries are textbook post-panic moves, often missed by those still paralyzed by fear. And before that, be the one who says I was here before 100K. I'm on a mission to hit 100K subscriber before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comment. Let's win and grow together.
Well, this is still the most hated V-shaped rally. And it, of course, has a lot to do with when stocks fell in a waterfall decline into April. Nobody likes to be sitting on stocks. So a lot of folks liquidated at the lows. But we know that whenever the VIX is above 60 and falls below 30, you've made a decisive blow. And now visibility is better. Tariffs aren't as bad as we expected. And the inflation impact actually has been very muted. And actually, outside of tariffs, underlying inflation is actually much lower than people expected. And I think the Fed is, even if they're holding now, the bond market doesn't believe it. If you look at the 2-year, they think the Fed's 2 cuts behind. The 10-year is now down to 4.2, which means the Fed can be more dovish in the next 12 months, and that's a tailwind for stocks.
Can you explain how we have this big, beautiful bill, which people are saying $3.3 trillion added to our deficits and everything else, and yet you're looking at the 10-year coming down?
Yes. It shows you that markets don't view the U.S.'s debt sustainability purely as its budget, because I think there's a lot of hidden value on the U.S. balance sheet, from natural resources to buildings they own to the value of gold is undervalued. And in a way, when people say the U.S. can't find buyers of its treasuries, it's actually finding it. It's going to be stablecoins. Stablecoins are going to replace any foreign holder of treasuries, because
is that a temporary situation? Like once you do that to a certain level, then sort of living in its own universe?
True. It depends. Stable coins are 250 billion today. The total circulating supply of dollars is in the, nearly 10 trillion. So stable coins can grow. A lot of stable coins transactions happen outside the U.S. So dollar dominance could actually be much higher in a stable coin world. But the main thing is it's at 4.2% the 10-year. And I think that means the bond market isn't as concerned.
Right, but we thought that the bond vigilantes were going to say, no mas, we're not doing this.
Yes. I think the bond vigilantes are essentially correct. The U.S. should not be running a deficit like this. But for whatever reason, we're not at the levels yet where debt sustainability is a question.
Could that change? It's weird when these sentiment changes come. They usually come without warning.
That's right. Bond markets run on confidence. So there may be a moment where the bond market loses confidence. As long as the dollar is...
Jamie Dimon's worried about that.
Yeah, and you should pay heed to Jamie Dimon because he has his finger on the whole economy.
Where you still look at your year-end target is at 6,600 still? So that's up about 8% from where we closed on Friday?
Yeah, I think that the reason people don't think there's more upside, I think there's upside to 6,600 because the PE of the market can go up a lot. We already had 5 shocks. We had the COVID shock, the supply chain shock, the inflation shock, the Fed fastest hikes in history, and then we had the tariff shock. So 5 shocks in 5 years.
5 years, yeah.
And earnings kept growing. If this was like a stock, we'd say, look, if you tried to kill it 5 times and it still grew earnings, we would put a much higher multiple on it.
Jim Chanos was talking on Bloomberg the other day and said that what we're seeing right now in AI reminds him of a lot of ways in the dot-com bubble. Now, the numbers and the earnings are very different, but he was talking about the Ciscos and the Lucents and some of those companies that were selling the things to shore up the internet. And I think he's looking at all of the CapEx spending that's taking place and saying it's great for right now, but it could change drastically and relatively quickly too.
Yeah. I was a tech analyst during that time. I think it's very different. We have to remember the internet boom was companies like Yahoo creating web pages that were raising venture capital funds to create web pages. So the purchase of the equipment was based on like creating web pages.
Right.
AI has use cases like replacing workers. So you have true dollars for a company to measure how much they're saving. And so until we get to the point where AI doesn't save you any money,
right,
then it's a bubble, but
because
maybe it's undervalued.
Right.
I'm still a big fan of Bitcoin because I think it is, digital gold. But what we've seen in the last, really in 2025 is the financial services industry and crypto are converging. And it really started with stablecoins, which is the ChatGPT of crypto, right? Because it's viral adoption by consumers, businesses, banks, and now even Visa. Underneath the stablecoin industry is Ethereum. That is really like the backbone and architecture of stablecoins. So it's important to create a project that essentially accumulates Ethereum to essentially protect and have some influence on the network. So that's why we're creating this treasury vehicle to buy Ethereum. The more Ethereum that's accumulated, the more secure the network is. And I think it's also sort of the architecture that future banks will have. When Goldman issues a stablecoin and JP Morgan doing it on Ethereum as a layer one blockchain, they're going to want to secure it by staking Ethereum. So we're trying to get in front of that by creating a treasury vehicle.
And just so I understand, it's safer if you own more of it. Explain why that would be.
Well, Ethereum is a proof of stake network.
Right.
So unlike Bitcoin, which is proof of work and miners do all the work for you, and that's why you have decentralized trust, in Ethereum, it's important for these entities to essentially validate transactions. So by becoming a staking entity, you're sort of securing the fidelity of stablecoins. So you don't want a stablecoin like USDC or USDT to be on a blockchain that's outside the purview of the US. And so I think Ethereum is a high quality, the second largest blockchain network, and it's over 51% of stablecoins, and 30% of all fees on Ethereum are actually stablecoin revenue.
So we even have the Treasury Secretary, Scott Bessent, talking about how stablecoins could be very positive. He likes them, likes to see what's there. But you're basically saying with this, and we've also seen what happened with Circle, the stablecoin issuer, huge run up after their IPO. So you're basically saying that this is the new Bitcoin. You're getting in at a very early stage.
Correct. That's right. Because let's say stablecoins, which is $250 billion today, gets to Treasury Secretary Bessent's reasonable $2 trillion. That's a 10 times increase in size. By the way, already stablecoins are the 12th largest holder of treasuries. They'll become the number one holder by then. Mm-hmm. US dollar dominance is 27% in GDP terms. It's 57% of central bank reserves. It's 80% of financial trading transactions. It's 100% of stablecoin denomination. So by getting to $2 trillion, you're ensuring dollar dominance. This is very good for the US, but $2 trillion of stablecoins is a lot of network fees for Ethereum.
So BitMine Immersion, what you're doing is a $250 million private placement, which is all going to be put into Ether?
That's right. We created a carefully curated list of investors to bet on this. If you look at the press release, it is the blue chip, both in the financial world and in the crypto world. We have
Founders Fund, Kraken, Galaxy Digital.
Yep, Pantera. Yeah, so these are in the crypto world, and these are like sort of the blue chip crypto entities. And of course, Founders Fund is legendary in the traditional financial world.
And how do you measure this? It's just based on exactly how Ethereum is trading?
Well, yeah, the strategy of the company is going to be based on how much Ethereum is held per share.
Okay.
And as of today, it's $4. And the company, as we explained in the press release, can increase its holdings of ETH by, getting yield from Ethereum, doing financing transactions at a premium to their holdings, and of course, if Ethereum goes up. So I think there's three ways that value per ETH actually grows.
Tom Lee pushes back on Jim Chanis's comparison of the current AI boom to the dot-com bubble. Unlike 2000, when companies chase speculative internet ideas with little economic output, today's AI investments are producing tangible cost savings and real productivity gains. Lee admits that some capital expenditures might be overextended, but the core AI thesis is rooted in actual ROI, not hype. Until AI stops delivering measurable business value, calling it a bubble is premature.
The bill is moving through really at record pace. If you think about what happened back in 2017, it was December, so this is happening in half the time. To Senator Thune and Speaker Johnson's credit, they've moved this thing along. They're following President Trump's leadership. My boss, Secretary Bessent, is working tirelessly, meeting with everyone. She was a point person, obviously, with the Big Six. It's moving along great, Andrew. So,
what did you make of the comments over the weekend? We've talked about him, too, on the broadcast today, by Elon Musk, who called this bill utterly insane and really went after it more because of solar and wind and some of those things. And obviously, President Trump's made some comments about that as well.
If we don't pass the bill, we're going to have the largest tax hike in U.S. history, and the economy is going to roll over. Because what we have in the bill are very pro-growth initiatives. We're doubling the small business expensing. We're increasing opportunity zones. We're making the President Trump tax cuts permanent. Also, another big thing is factories now get 100% expensing. That's going to be hugely additive to the economy and building. So do you not want to have that? Do you want to have a big tax hike, a record tax hike, and kill the economy next year? Like, that doesn't make any sense.
But what do you say to Elon, for example, on the solar stuff specifically?
Well, I think a lot of that is clearly has been wasteful. It's not very economically efficient and wouldn't exist without a government subsidy. So I could.
You think it's just his solar interests that happen?
Well, I'm not sure. I can't speak for him, but I could tell you that I think that it's an excellent bill. Look at the markets.
Right.
And I was telling people before I was lucky to join that the economy was very healthy. That really what mattered with uncertainty was getting this one big, beautiful bill through. As the Secretary has highlighted, it's phenomenal. We've had the largest recovery after a 15% correction in the S&P on record. So that's telling you the market is excited about what the
By the way,
business...
they seem to be, even what we thought of as the bond vigilantes coming out in force, they're not today. It's actually the opposite.
And the other thing, what I would tell Mr. Musk is if you look at this one big, beautiful bill, the tax relief to families is huge. It's $600 billion in tax cuts. The CEA is estimating the average family could receive upwards of $10,000 plus, almost $11,000 in...
Tom Lee paints a picture of a market that's misunderstood, underappreciated, and far more resilient than most realize. From inflation myths and bond market signals to the explosive growth of stablecoins and Ethereum's evolving role in the digital economy, Lee sees a powerful convergence underway. His bullish outlook isn't based on hype, it's grounded in macroeconomic data, long-term structural trends, and the accelerating momentum of technological innovation. *You won't believe. What's next? Click and see.